Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today we're diving into a proxy statement, and trust me, it's not as boring as it sounds. We're going to look at stock options, reverse stock splits, and even a little bit of corporate drama, all wrapped up in this regulatory filing. It's like a financial thriller, but with more numbers and fewer explosions. This proxy statement reveals a company at a crossroads, Neumora Therapeutics. They're asking shareholders to vote on some big changes, including potentially reducing the price of existing stock options for employees, which could incentivize them to stick around, and something called a reverse stock split, which could make the stock more appealing to investors. These decisions have consequences for everyone involved, from executives to everyday shareholders. First, let's talk about who Neumora Therapeutics is. They are a company focused on developing new medicines for brain diseases and disorders. They're trying to find better treatments for conditions like depression and Alzheimer's disease. So why are we looking at this document? It's a notice for their annual meeting of stockholders, which will be held in May 2025. It outlines the things shareholders will be voting on, big decisions like who gets to sit on the board of directors and how the company handles its money. One of the main items on the agenda is electing directors. These are the people who oversee the company's strategy and performance. 2 Class 2 directors are up for re-election. Basically, stockholders get to decide who they want representing them, and guiding the company. Ala Halawa and Maken Ho are both running again and have been nominated to serve as Class 2 directors. The board recommends voting for Ale Halawa and Maken Ho. The board believes they are the right people for the job. Next up, stockholders get to ratify the selection of Ernst & Young I as the independent auditor. Think of auditors as financial referees, making sure the company's books are accurate and fair. Stockholders get a say on whether they trust the company's pick for this important role. Now let's talk about the fees paid to Ernst & Young, the accounting firm. In 2024, Neumora paid them about $3 million, over $2.4 million for audit fees, which includes checking the company's financial statements, and about $473,000 for tax services. In 2023, the total was about $1.5 million, with most of that being audit fees. It seems like they used them a lot more in the past year. Again, the board wants to keep Ernst & Young. It's their recommendation to vote yes on this proposal. Here's where things get interesting. The company wants to reprice some of its outstanding stock options. Stock options are essentially the right for employees to buy company stock at a set price in the future. It's a way to incentivize them to work hard and increase the value of the company. But if the stock price drops significantly, those options become less valuable, maybe even worthless. They're underwater, as they say. Neumora's stock price has taken a hit recently, and the board is worried that these underwater options are hurting employee morale and retention. So they want to lower the exercise price of the options to make them more attractive again. This could help keep employees motivated and aligned with the company's goals. This table shows the current situation with these stock options. The exercise price of these stock options range from 1.697, but as of April 1, 2025, the closing stock price was about 91 cents. You can see why the board is getting worried. Paul Burns, the chairman and CEO, has a lot to gain from this. His options cover over 3.7 million shares. The board of directors recommends shareholders vote for this proposal. Now let's tackle the reverse stock split. This is when a company reduces the number of its outstanding shares by combining them. For example, a 1-for-10 reverse split means that every 10 shares you own become 1 share. The goal is usually to increase the stock price, which can make the company look more attractive to investors and help it meet stock exchange listing requirements. The board is asking for the authority to do a reverse stock split at a ratio between 1-for-5 and 1-for-30. This gives them flexibility to choose the ratio that they believe will be most effective. It's a bit like saying we might cut the pizza into 5 slices, or we might cut it into 30, depending on how hungry everyone is. The reverse stock split does not actually change how much stock the company can issue. So if they do that, there will be more authorized and unissued stock, basically meaning the board can create more shares if they want to. This also gives them some advantages if someone attempts a hostile takeover of the company. Here's a table showing how the reverse stock split would work at different ratios. The board is asking shareholders to approve the reverse stock split. Next up is the audit committee report. This is where the audit committee basically tells us that they did their job. They reviewed the financial statements with management and they believe everything is in order. Now, let's shift gears to corporate governance. This is about how the company is run and who's in charge. Paul Burns is both the chairman of the board and the chief executive officer. This means he has a lot of power because he oversees the company's strategy and day-to-day operations. This is where the company discloses any deals they've made with people who are connected to the company, like directors or major stockholders. It's all about transparency and making sure there are no conflicts of interest. One example is the Blackthorn acquisition. Part of the deal involved contingent payments to former Blackthorn shareholders, with some of those shareholders also being Neumora directors or affiliated with major stockholders. Matthew First was a board member of Blackthorn and got paid $132,481 for his part. Paul Burns, who is now chairman and CEO, was also paid over $600,000. Finally, let's look at who owns the company. This section lists the major stockholders and how many shares they control. This information is important because it shows who has the most influence over the company's decisions. Amgen owns almost 22% of the company, making them the biggest single stockholder. Erashio Venture Partners owns just under 20%. Paul Burns owns a little over 5%. All the directors and officers as a group owns just under 27% of all outstanding shares. Oh, was the story here? Neumora Therapeutics is at a crucial point. They've had some setbacks in their clinical trials and they need to take action to keep employees motivated and attract investors. The proposal to reduce the stock options for current employees might be a good idea. If a company fails, employees will leave and the company will fail for sure. It is a little bit risky because stockholders need to agree on taking a loss and giving current workers free money. However, it is a good move that protects the company. The reverse stock split is more of a gamble. It could increase the stock price and make the company more attractive, but it could also backfire if investors don't like the move. It will also mean the company has much more authorized stock to issue. From Warren Buffett's point of view, more authorized but unissued stock is bad. It signals the company will be issuing more stock in the future, which will dilute ownership of the company and decrease stock price. That being said, the company clearly has some good backers like Amgen and Arca. Ultimately, the decisions are in the hands of the stockholders. They'll need to weigh the risks and benefits of each proposal and decide what they believe is best for the company's future. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives. What should we decode next? Let me know in the comments below.